worst year for core bonds going back all the way to the index's inception in 1977. Take a look at this chart, and I think this helps us to see this visually. This chart shows the path of the return for the broad U.S. bond market over the years going back all the way to 1977. So each of those gray lines is the return over time for a different year. What you see, the purple line is for 2022, and it's well below any of the other years at this point in the year. So we've got not only the worst year on record for bonds, but by a wide margin. So let's talk about that. Let's talk about why that is the case. When we're talking about the investment grade bond returns, there's really two things that have a big impact on their returns. First is their starting yield, and the second thing is the change in yield over the time period. So we started the year, and take a look at this chart, and you can see for several different parts of the bond market, the U.S. aggregate bond, which is the broad bond market, treasuries, the 5-year treasury, and then for muni bonds, starting yields of 1.7, 1.3%, and 1.7%. So we started with very low yields. But then look at how much they rose over the last 6 months. We saw the U.S. aggregate index almost double, up 1.6%. 5-year treasuries more than doubled, up 1.75%. Muni bonds up 1.1%. So we started with very low yields. We had a very sharp increase, very big increase in yields over the 6-month time period. And that is what has led to a very poor year, or very poor 6 months for bonds. Now we've got a lot of people who say, well, the Federal Reserve is still raising rates. Won't that mean that bonds' second half of the year will be just like the first half? And I think there's a couple things to keep in mind. First, the Federal Reserve is changing the very shortest maturity bonds. They're setting the federal funds rate, which is essentially very, very short maturity bonds. It's the market and investors who are setting the yields for 2 and 3 and 5 and 10 and 30-year maturity bonds. So when the Federal Reserve has been talking about raising interest rates and talking about their plans to continue to raise rates for the rest of the year, investors in the bond market don't wait for that to take place to adjust the prices on these bonds. They go ahead and do it. And so for many cases, we think it's likely that bonds have already priced in these interest rate increases that the Fed is planning to do. If they haven't fully priced it in, they've gone a long way towards doing that. So when we look at the situation for bonds from here, it's a very different situation today than it was at the beginning of the year. First, interest rates are much higher. So you're going to have a cushion from that income if rates rise further. Second, the bond market and investors have already anticipated what the Federal Reserve is planning to do, and they've priced that into bonds. And so from here, we think that bonds are in a much better position. Higher rates, and they have already anticipated what the Fed is planning to do. So that puts them in a much different position, a much different and better place from here.